Good afternoon, ladies and gentlemen, and thank you for joining Burgess Hodgson for another of our question time style sessions. As a firm, we look after many GP practices, practicing GPs, as well as consultants operating in the sector. We have previously covered more general topics, but wanted to tailor this one to deal with and hopefully share some insight into the specific complexities faced by businesses operating with NHS contracts, and also the recent and upcoming changes, of which there have been many, and some of them quite significant. In order to bring you that expertise, you need an expert panel, and I'm delighted to be joined by some of the firm's specialists in the field, as well as a medical specialist financial advisor who has made it his life's work to look after the healthcare sector. Before he introduces himself, first a few words from the team here at Burgess Hodgson. I'm Simon Bailey. I'm a dual qualified tax advisor and accountant with over 18 years experience and a partner of the firm since 2016. I've got an interest in professional firms, including GP practices and consultants, and will be hosting this session. We're also joined by another partner, Kenton May, who would like to say a few words.
Good afternoon, everybody. As Simon said, this is the medical team. From an accounting point of view and a tax point of view, I think over the last few years, the challenges really have been surrounding the annual allowances and the tax charges for medical professionals. I think currently the flavour of the month for us and actually for over the last 6 months or so it's been PCNs. This has chucked up all sorts of challenges from an accounting and tax perspective, which we are working our way through, as are most of the specialists in this area.
Thank you, Kenton. Also on the panel is Guy Vine, one of our accounts associates.
Thanks, Simon. Hi, I'm Guy. I'm a chartered accountant and associate at Burgess Hodgson. I've been at the firm for about 10 years. I spend the majority of my time assisting GPs and practices with their accounting needs, helping them fill out superannuation forms and certificates, and also assisting with the annual allowance charges.
Thank you, Guy. And to assist from a taxation point of view, we have one of our tax associates, Gemma Jordan.
Thanks, Simon. As you've guessed, I'm Gemma. I'm also an associate of the firm and a chartered tax advisor. I have a number of years' experience dealing within the healthcare sector. A large majority of my portfolio relates to GPs and their practices, together with other healthcare professionals.
Thank you, Gemma. And finally, but by no means least, we welcome Paul Gordon, who will say a few words to introduce himself, although I'm sure many of you will already know him.
Good evening, all. I'm Paul Gordon. I still just deal with doctors in all aspects of finances. Without question, as Kenton pointed out, the annual allowance has become more of an issue for just about everyone out there, but we've picked up on more changes that are either likely to be due, depending upon a consultation that's running at the moment, as well as better announcements earlier in the year before lockdown, and we'll spend the afternoon and evening answering whatever questions you may have.
Thank you very much. Right now, you've met the team. Just a few housekeeping points before we begin. We should make you aware that this is being recorded to be shared publicly later. This is an interactive session, so if you do have any questions, there are several ways to get our attention. Firstly, you're more than welcome to unmute yourself and speak directly to the panel, but we do ask you to remain muted at all other times. And at the bottom of your screen, you'll see an icon menu. If you select the Q&A, you can type any questions you have there, and I'll do my best to draw bring them to the attention of the panel. You can also submit questions via the chat as well. Anything we don't have time to answer live, the panel will try to follow up after the event as well. If you do have a question but aren't prepared to share it publicly, you're also more than welcome to contact us after the event, and details will be provided of that at the end of the session. Finally, many of you have already submitted questions by email before, so we do have a list of advanced questions that we will also try to make our way through as well. On that note, we'll open up the session to the floor. If anyone's got any questions for the panel, you can submit them or please speak up. But perhaps while you're gathering your thoughts or perhaps typing out your first question, I'll kick off a question with a question that's been emailed in advance, if I may. And actually, this one direct this one towards Kenton first, if I may. The question's come in. It says, we're looking at setting up a separate company with another practice in the area to provide additional services. We've been advised that the shareholders themselves need to be individuals and can't be the practices. Are we able to distribute any profits to the partnership as well?
Okay, yeah. I think the simple answer to the latter part of the question is yes. Profits.
That's done then.
Yeah, profits can be distributed as partners, but it might be worth just expanding on that briefly. It's worth understanding that a partnership isn't a separate legal entity. It's not like a limited company. It's not a corporate body. So the partnership itself can't be a shareholder. However, the best way to structure, or the only way really to structure this, is for a named partner to be the shareholder as a nominee on behalf of the partnership, and then he or she holds the share on trust, bare trust for the partnership. What is important then, though, is that the partnership deed itself addresses how any dividend income distributed from the company is then allocated between the partners, and that must be dealt with in the partnership deed. But the answer is yes, you can get profits out of a company, but you do need to structure it so it's legally appropriate. Yeah.
Guy, perhaps, I mean, are there any complexities if you've got, obviously we're talking about different partnerships, different practices in the area collaborating, if they have different year ends and things like that, is there other things to think about?
Yeah, so different year ends is a key point there, Simon, and perhaps Gemma will actually expand a bit more on that. It's all around the dividends and when they're taxable. It won't necessarily fall into the financial year of the practice if they've got non-March year ends in the practice.
So, I mean, on that point, Gemma, we've got a company, it's got profits, it's going to, trying to make some distributions. How do the partners themselves, how are they sort of taxed on that ultimately?
The partners themselves will need to account for the dividends on a tax year basis. So if you have an accounting year to, say, 30 September, although you will know the dividends recorded during that period, you will also need to look forward to 31st of March, 5th of April, and then also account for any further dividends due to you for which the accounts aren't paid to you, for which the accounts won't have been necessarily have been prepared.
So it's going to rely on a certain amount of collaboration between the practices.
Yes, definitely.
Yeah, fine.
It's sorry, Si. It's also worthwhile to think about different share classes as well, especially if there's more than one practice collaborating in that kind of scenario, because sharing profits in different ratios is quite a difficult thing, and typically they might be on a patient list size or something along those lines. So having a good shareholders agreement in the company is also something to bear in mind.
Fine. By that you mean it's awkward if it's based on list sizes, for example. It's not always straightforward to change the sort of sharing ratios between from a year to year basis.
Exactly that. In a partnership, which most GPs are used to, it's very easy to divide up the profits as you see fit. As with any partnership, you can do that, but with companies, the dividends are sort of paid on a shareholding basis. So you've just got to get that structure in place and get good legal and accounting advice.
So just forward planning is the key.
Indeed.
Fantastic. Okay, thank you. I've just got one come through on the chat. Actually, if I can come back to you, Guy, this is probably going to be the main crux of this session, really. We're going to dive straight into annual allowances by the looks of it.
It's a surprise.
I think it's what most people are going to be keen to know about. I'm expecting annual allowance charges as my earnings have been good over the last few years. I can see that I'm able to make a scheme pays election. Hopefully you'll expand on that for some annual allowance charges as I'm aware of. Should I get the scheme to pay? What is the downside? Are there any other tax consequences or any other consequences to think about? I know it's quite an in-depth question there, but
yeah, it is indeed.
If you can start
so it's really important with scheme pays elections and the annual allowance charges in the whole, really. They're really affecting GPs, and they have been over the last few years. And it's not something that any one professional can really advise on in full. It covers tax, but it also covers your final pension entitlement as well. And that's particularly why we like to work with IFAs such as Paul, who we've got on the panel today. So in terms of the downside of making a scheme pays election, Paul will certainly elaborate on this, but it will affect your retirement benefits if you make a scheme pays election. You will get less in your pension. And potential other consequences to think of are really around accrued interest on late payment of tax. So the key there is all around the timing of information that GPs are getting this from PCSE and from NHS pensions. So typically we're not actually getting the right information that you need to fill out a tax return in time to fill out the tax return. It's always coming much later in the year, and we're always having to amend tax returns as a consequence. So knowing what information you need to put on your tax return has not actually been possible. So that means that a subsequent tax charge arising that you weren't initially aware of potentially will start to accrue tax, because the tax is technically paid late. And so whilst the scheme will pay the tax charge if you've got in within the deadlines, there's still the interest charge you may suffer as a consequence.
I mean, you mentioned deadlines. In terms of timescales, I know, I'm sure Paul will tell us whether we're winning the war against the PCSE, but what are the deadlines at the moment? It's going to cover his face there.
So typically the deadline is usually 31st of July following the accounting year. So for instance, we would normally expect the March 19 year end to have a deadline for scheme pays elections on the 31st of July 2020. However, this year, due to the coronavirus crisis, that has been extended. It's been extended twice. It was extended to the 31st of October, and now it's been pushed back even further to the 31st of March. So you should still be well in time if nothing's been done just yet.
So still plenty of time to get the advice. Paul, anything to add in terms of the sort of the difficulties you're facing at the moment?
Yeah, there are a few points. Guy is absolutely right, and the crucial consideration is that the use of scheme pays absolutely works, assuming it's the last resort. So if you wanted a black and white answer, if there is no money in the bank, there is no way of raising a debt to borrow money, then scheme pays without question works, because it comes as a loan from your pension. But as Guy pointed out, it'll reduce benefits at retirement, which is definitely bad news. You're going to get less forevermore. But potentially, depending on where you are against the lifetime allowance, which is another topic, if you've exceeded the lifetime allowance, then actually asking government to technically pay a tax charge using your pension pot may actually reduce the benefits in favour, so the lifetime allowance is either exceeded by less or not at all. But going back, if you are in your early part of your career, you may well have 30 years of interest potentially that's going to be added. That's interest that no one can guess. No one can quantify what consumer price index will be even next year, let alone for the next 30 years. So not quite cut and dried. Without question, in most cases, you would try to pay debt from savings or reserves because it's finite. You know exactly what you're paying and what you're receiving in return. But actually, it's greyed because of both the complexity around the annual allowance, but also the bigger picture. So if you are a partner, and by that I mean husband and wife or similar civil partnership, and you have two NHS pensions that will be paid into the household upon retirement, then actually the use of scheme pays can certainly work. It's just making sure that you're aware of both the positives, somebody else is paying your tax bill, the negatives, it could well be late because by definition the information arrives late, and it will reduce your pension. And how much it will reduce it by, well, that's incredibly difficult to calculate because of the unknown consumer price index between now and whenever you retire. Another consideration is that you must ensure, if you are using scheme pays, that it's dealt with before you retire. The election cannot be made after retirement benefits are payable. So that's an absolute essential part of planning. But beyond that, it certainly works. It's certainly being used by more and more people. It's irrevocable, which is one thing to consider, and it can be amended.
Hi, Paul. Sorry, can I follow up there just briefly? Because there have been a lot of tax charges from 16, 17 onwards since the tapering was put in place. But we do understand that the 1920 year, the NHS has agreed to fund any pensions tax charges, and this I'm reliably informed by yourself is covering GPs as well. But does that mean it's worthwhile just a blanket scheme pays elections for anyone that's concerned? Would you think?
I think you'll find that just about everyone that paid into the pension scheme in 2019, 2020 will probably submit a scheme pays election just to make absolutely sure, because they'll be given that period of grace to amend it. That's the crucial part. So elections can be made for as little as £1 per scheme. And that's important as well, because the majority listening in will probably now have one scheme for sure, but potentially 2 or even 3 schemes. Although that may well be subject to change in just a matter of weeks, depending upon how the consultation washes through. So certainly for 1920, I think given government's offer that for frontline clinicians, they will pay any annual allowance charges that have been incurred as a result of the NHS pension. So not if it's linked to a private pension or similar, but NHS link, then the likelihood is most will opt for scheme pays for that year. But it must be done before retirement.
And I think there's been some softening. I know the last few years we've seen sort of quite an issue with tapering and the annual allowance. Obviously, you've normally got a £40,000 sort of growth limit for your pension scheme, tapered down to 10. I understand that they've now increased the limits. So hopefully it will take out some of this issue for some of the people listening. And so you can now, your income limits going up to sort of 200,000 from 110 and so forth. So.
Yeah.
It's important.
I think if it's once you go over 300,000 roughly now, I think is the sort of key number to think about for the current year. I think, yeah.
And that's total income, isn't it?
Yeah.
Yeah, it's important to remember though, it's not a complete solution. If you've got a large pension pot, if we have some years of rising inflation, you can still breach your £40,000 allowance and still get a tax charge. And I would say most GPs that we see right now probably don't have any unused allowances left to utilise from prior years because of that exact fact that that inflation was so high in 16, 17, 17, 18. Yeah. So it's not the blanket solve, but it's going to ease the pressure somewhat, we expect.
Yeah. To add perhaps a fraction more there, the likelihood is that the adjustment has been from a threshold income of £110,000, and the key understanding here, that's total taxable income from all sources. So not just work as a GP, but it could be rental income, it could be external out of hours income, it could be any source of income that you receive. If that exceeded 110,000 of total taxable income previously, you potentially saw your 40,000 of allowance tapered down. The announcements by Rishi Sunak pre-lockdown, which feels a lifetime ago now, increased that figure by 90,000 from 110,000 to 200,000 before the allowance would start to reduce. Key differential at the end of that, up until this year, the lowest the allowance could drop to was 10,000. It could now drop to 4,000. However, 96% of GPs should be lifted out of the tapering element because it's been increased to 200,000 as a threshold income, which is certainly going to work in favour of the majority.
Okay, thanks, Paul. I mean, Gemma, you deal with a lot of the sort of tax returns for sort of GPs, and Guy mentioned that we did have a few years where people were sort of exceeding their allowances, but had kind of unused allowance. Have you seen that? Are we reaching a point where most of those have been used up, so that people have got to think about them, or?
Yes, definitely. As Guy said, the 16, 17, 17, 18 years showed sufficient growth within the schemes and have pretty much eaten away at all the brought forward annual allowances that we had for a large majority of our doctors. So the 40,000 hopefully is going to help a lot, but if the growth continues at the rates that it was, or if it goes back to those rates, I still think we will see charges, albeit they will be much smaller.
Yeah, I mean, in terms of looking after our clients, obviously we've spoken about these forms and things, certificates not coming to us in a sort of a very timely fashion. What are we doing kind of to sort of give advance warning or notice for clients?
Yeah, so we would typically ask all our clients to sign a letter of authority so we can liaise directly with NHS Pensions. We've tried it with PCSE, but that hasn't really worked very well. So NHS Pensions still very useful, still very handy, and they pick up the phone very quickly. So we get that sent off. That gives us the ability to call up NHS Pensions, ask them questions about fund values, growth factors, well, how much growth they've had, the GPs had in prior years. And we use those figures to estimate what the growth would have been, or what we think the growth would be in the current year that we're currently reporting on. That gives us a good flavour of the likelihood of an annual allowance charge, and we go from there. And of course, bring in the IFAs at the same time to try and advise accordingly if we think there's going to be an issue.
Okay, that way we can give them advance warning of what their sort of tax payments are likely to be in January.
Yes, we do give them an estimate of what we think it will be. We have been waiting till we've got the actual figures from NHS Pensions before doing final submissions to the revenue, just to avoid the need to keep amending tax returns. Because although our calculations have been relatively accurate, there's always a chance that they may be different.
Well, thank you. I mean, sticking with pensions, I think we'll move on to another topic in a second. But you know, Paul, you mentioned about this consultation process that's going on, and there's obviously been in the news recently. What's the sort of, I know that there's still, it's not final in terms of its outcome, and there've been various proposals made in terms of flexible accrual rates and things like that. But what's the likely outcome from this consultation at the moment? How's that going to impact on our clients?
I think potentially a very good outcome. What is being proposed, for those of you that aren't aware just yet, right now, any of you that were automatically transferred from your older version of the scheme, either the 1995 scheme or the 2008 scheme, on the basis of your age to the 2015 scheme, government lost an age discrimination case, which effectively means they have to unravel that. And the consultation is suggesting that the transition occurred after 2015. So the period for 7 years between 2015 and 2022 will be known as the remedy period, whereby anyone that was automatically transferred across will be given the option to determine whether they want that 7-year period aligned with their older version of the scheme, or if it's to be retained within the 2015 scheme. Now, that is going to cause about 1 million pieces of work, according to the Pensions Agency. Now, I'm very fond of the Pensions Agency. They are excellent. And when they get correct information, they're able to provide all of the various numbers that these guys need to file tax returns and you all need to receive your pensions. It's not practical for them to have 1 million pieces of work increase to their workload without substantial investment, which is why I think the cost at the moment is estimated to be in the region of 17 billion. Now, I think that's to rectify the whole problem, including making good either retention in the current new scheme or reverting back to the old scheme. But it's an extraordinary amount of workload that many are going to see. What should be the outcome for the next month or so, and the consultation is still live, is that if it's accepted, everyone that was transferred will be given the opportunity after 2022 to decide whether or not they want to instantly or immediately transfer back into their old version of the scheme, or even defer it until retirement, whereby you will be given the information to compare both the old version and indeed the newer version to see which leaves you better off. Now, that would defer the workload. It would spread the workload from a pensions agency perspective, but would still give an extraordinarily immediate jump in their work that will last for many years, because some would have transitioned across very, very briefly into their, or very early on into their NHS careers. Others will transition across pretty late on, perhaps even in their 50s. And everyone in between will have that as an option.
And this at a time where they're already contracting out the certificates themselves to accounting firms. Sorry, Guy, do you have something to add?
Yeah, so Paul, is it, from the options available, presumably it will be completely different, the answer to everyone's question as to which option should they take.
Do we have the entire million listening in? Do we know? We can just tick them off one by one. Probably not, actually. Although that was a flippant answer to start with. If you think a number of the GPs that you'll deal with, and indeed the consultants and juniors for that matter, GPs and consultants, because they'll typically be more senior, will have the ability to add 7 more years to the oldest version of their pension scheme, which is either accessible at age 60 or indeed age 65, certainly earlier than their state retirement age. If it's linked to the oldest version, that 1995 scheme, it's automatically giving them a pension and lump sum. So many will see that it enhances earlier access to the pension and gives them a lump sum that is greater than they could otherwise have expected. They can still increase it, of course. They can give up £1 of income for £12 of lump sum in whichever of the 3 schemes they're in. But feedback to date has been that more and more people are keen to see that 7-year period, or up to 7 years, because many have now opted out, but up to 7 years transfer back into their oldest version of the scheme. But it'll bring with it its own issues. It could potentially inflate the annual allowance growth.
There we go. There we go. That's where we're concerned.
Yeah. But equally, it could deflate. I mean, it could be less. So there's a lot to unravel here, and the workload involved will be staggering.
And presumably, they should also factor in the lifetime allowance when they're thinking about this as well.
I'd say so. I think it'll be across the board. But if you certainly ask people at the moment, would they like to consider retiring earlier or later? I think the answer would be standardized across the board, and with not many answering much later would be great. Lifetime allowance, drawing pension benefits earlier could mean an actuarial reduction will apply. That could bring the allowance calculation down, which can work in favour of individuals. Equally, it means a lower pension forevermore and so on. So there's so much to factor in before an answer can be given. But the general broad brush answer that I've had in quite a few conversations of late is that people can't wait to be given the opportunity. Assuming the consultation is a success, they can't wait to be given the opportunity to transfer back into that older version of the scheme.
Prior to the consultation, there was a lot of talk about potentially amending scheme rules to allow it to be a bit more flexible, and bits such as the 50-50 rule. Is that still on the table potentially as making it easier for people and doctors and GPs to select what they pension and how much?
I'm not sure which table, but I know it's being discussed, and it's being discussed at perhaps slightly more extensive options. So the initial consultation about this time last year, actually just slightly earlier, was perhaps half of pensionable income could be pensioned. That would lessen growth, lessen some of the issues we're discussing here about the annual allowance and the tapered annual allowance and so on. That didn't seem to go far enough for some that were negotiating on behalf of the medical sector. So what was then proposed or consulted on was actually potentially 10% increments, which would make a difference. But there are obvious negatives of that. If you're only pensioning 0 or 10% of your income, your pension benefits at the other end will be lower. So every answer is met with both positives and negatives. And it's very much a case of what sits best with you as the individual or you as the couple, and what suits your finances behind the scenes. That's one thing to take from this evening. And generally, because sadly, there will be GPs and consultants out there that have done the same as their colleagues when it comes to the pension, or any other planning for that matter, because their colleagues are sensible or financially aware, and yet their finances behind the scenes will be different. So I think it's still being discussed, as in it isn't simply on the front desk at the moment to be rolled out shortly, but it is something that I think gives slightly more flexibility and would give people arguably more control over the direction of travel around the annual allowance, the growth generally, and what benefits they're likely to receive in the future.
Okay, thank you for that, Paul. I'm sure we'll be revisiting pensions and the like, but we've got a question come in about expenses. So this is going back to the tax returns, Gemma, where we're sort of preparing returns in order to give, provide estimates. Obviously, part of that needs to be sort of factored in is GP's expenses. Why do we need that information at the same time?
So any personally incurred expenditure needs by partners of a partnership needs to actually go through the accounts and the partnership tax return. So we need that information at the same time as preparing the accounts and not the later date of tax return filing. Previously, I think people thought that they could do this on their own individual returns, but you're not allowed to do that. It has to go through the partnership return. It's really important. So what we do for people is that we provide an expenses questionnaire for all our partners, send this out with a list of expenses that they may have incurred during the year, things such as course costs, books and journals, use of home as office claims, which we would expect to potentially be greater due to the current situation. Then you've also got your telephone bills, all various different costs. We send out this questionnaire, which hopefully assists in the collation of the information. We find it's quite useful.
In terms of travel costs, presumably they can claim for sort of use of their own car and things like that as well.
Yeah, so in terms of travel costs, there's like 2 ways that they can do that. You can claim standard revenues approved mileage rates for your business miles travelled, or you can look to claim capital allowances on your vehicle and then the annual running costs of the car. Obviously, that will be a percentage of how much you believe you use that for business. Cars can be quite generous. Electric cars seem to be quite popular at the moment with 100% first year allowances. However, again, there are private use adjustments that need to be considered. And also, if you sell the vehicle within a couple of years, there's the chance there could be a balancing charge. So some of that tax relief might come back into charge.
By first year allowance, you mean you can effectively... Well, do you want to expand on
Sorry. Yeah, so a first year allowance is 100% of the car's value you can have as a tax relief, subject to the amount of business use for that vehicle.
Can I ask a question, Gemma? Sorry to interrupt. You mentioned about the issue about the partner's individual expenses. And I mean, historically, the revenue probably didn't take quite such an interest on it, but they definitely are now. And if one partner decides to do his own tax return and claim expenses, and the revenue see that as an option to inquire into his return, that potentially could allow them to inquire into the partnership return, presumably as well. So it is important that they all coordinate their approach.
Yeah, it could. You're right. The thing is, there isn't actually anywhere on the partnership pages for an individual's return where you can actually claim these expenses. So they would be put on as an adjustment to profits, which automatically looks different. It's not an expenses category, so it is likely to draw the revenue's attention to it, perhaps. And yes, the partnership return would in effect be incorrect, so it is likely that could get looked at too.
Yeah, okay.
No, valuable point there, Kenton. A guy we were sort of chatting the other day on the subject of cars. You know, obviously you've got a car that you use for business. What if that's not available? Can you claim for other vehicles and things like that?
Yeah, so typically doctors and GPs in particular have been able to potentially claim for 2 cars. The reasoning behind that mainly was because they might be on call and suddenly, you know, their other half is using the normal car that they would usually use. So they've had to take another car, which is a perfectly justifiable reason to claim expenses against your taxable income. It's just worth bearing in mind, just to be able to back up any claim you are making, be aware of what the claim is, how much you're claiming, and reasoning behind it. Typically, it'll be a percentage private use adjustment. Say you might be 90% private use, 10% business, or either way. But being able to back that up is going to be quite key. It might be an area that gets expanded on and looked on even more so, particularly around in this current year, for instance. We would expect all of you to have used your cars a lot less. You'll all be on Zoom meetings and calling a lot more and far fewer patient visits and business meetings as you would normally do in a typical year. So we would expect car expenses to be much less this year. However, on the contrast, it does open up the scope for a much larger use of home as office adjustment.
Fine. I mean, in terms of sort of backing up, do you mean sort of rough mileage logs or just some kind of record? Do you mean
exactly that? If in an ideal world, everyone keeps a mileage log in their car, writes down every mile they do. Typically, we don't see that very often. There's a few good ones, but not many. If you're able to do that for a few months of the year at least, just to provide a guidance to what you typically do, that it's at least a good backup for any claim you make.
Fine, but possibly not the same rounded figure year on year. Is that what you're saying?
Yeah, we wouldn't like to defend that in an inquiry, I don't think.
Fine. Okay, we've got another question on the Q&A actually. We've got, it says, I can never seem to see how my regular drawings tie up to the profits in my accounts. Are you able to explain this? Kenton, can I throw that one your way?
Oh, yes. Can you just repeat it, Simon?
Yeah, of course.
Do you mind? Yeah, thanks.
So, I can never seem to see how my regular drawings tie up to the profit in my accounts. Are you able to explain?
Yes, okay, right. In very simple terms, profits are what have been earned. So basically, if you draw up your accounts and you come out with your profit figure, which is your surplus of your income over your expenditure, in very broad terms, there are accounting adjustments to it, but that is your profit. Drawings is what you actually take in cash from your business, i.e. it's an appropriation of profits. And one of the mismatches is always that, of course, you're drawing throughout the year. So you're drawing against effectively your current account within the practice or in your sole trade even as well, before you actually know what your profits are for the year. So you earn your profits over the year, and to the extent there's a difference, and normally you'd hope there to be a surplus of profits over drawings, or you have a problem, and some people do that. But if you have a surplus of profits over drawings, that is then available to carry forward for future drawings. But yes, they're different figures. Drawings aren't tax deductible, and profit is the key figure for your tax return, subject to the necessary adjustments for tax purposes.
We've seen some partnerships or individuals pay for their own tax, so they're drawing effectively almost on a gross basis and paying their own personal tax. Yeah. As a partnership, could they reserve for the sort of individual's tax within the accounts?
Yes, you can, and I mean it takes a bit more sophistication, but yes, you can if you have a decent accounting system, decent management figures, and reasonable forecasts of income levels. What you can do is set your drawings such that the partner's anticipated tax liability can actually be reserved within the partnership itself. And this is probably helpful for many people, because what we do find is sometimes partners take their drawings, treat it as their own income, and then when they get the tax bill, and particularly if there's been an issue with annual allowance tax charges, for example, they can be in the unfortunate situation where they're scraping around to find funds to pay their tax on the due dates, and it does happen. Yeah.
Can I add to that, Simon? Just on the providing for tax, it's worth bearing in mind that if the practice is withholding the tax, and it would be potentially useful for business cash flow as well, but the individual partners still remain individually liable for their tax charges. It's not the practice that falls liable. So for whatever reason, if the worst came to the worst and the practice did fail, the individuals are still liable for their tax charges if that was the case.
That was a valuable point. Thanks, Guy. So hopefully that deals with that question. If there's a follow-up to that part, then please come back on the Q&A. So it's only a matter of time. Now I'm going to go to one of our advanced questions. This is talking about PCNs. So I've seen some articles suggesting that partners may have to pay tax on the profits of the PCN. We're not going to receive any of the money, as all the income received was earmarked has now been spent. Am I likely to still have a tax charge? And Guy, I know you've been looking carefully at PCNs.
Yeah, sorry. Yeah, this is the first main year of the networks really coming into their own. Obviously, there was some participation payments in the 18-19 year, But this is the first year where there's actual service provision and additional income coming through. And part of that income stream is the core network payment, the £1.50 per patient, that's ideally delivered to enable the network to cover its overheads and its admin costs. And the crucial thing to note with that, the specific payment itself is a contractual payment paid in the financial year to March. So the problem therefore is that if the network has not actually incurred that many costs in the year because it's still early doors, that's actually creating some profits which can't be deferred because there's no right of recourse from the NHS to claim that back. So you may have earmarked it in the future to take on additional staff and administrative staff, or however you want to spend it within the network. But if it still remains in the network's bank account as at March 2020, then technically it could well be taxable, and should be disclosed as additional profit in each practice's accounts.
And likely, if they're going to pay the tax, they're likely to want to get their hands on the income.
Yeah, exactly that. And some problems could arise where it may have already been spent after March, but the costs have been incurred after March, so the profit is still there, and it may still be taxable. You would expect to get the relief in the following tax year for that, though.
And presumably it's transparent like that because the PCN itself is not actually a tangible thing in its own right.
Exactly that, yeah. The PCN is not a legal entity in itself, and consider it more like a joint venture. You're agreeing to go into a little business with the other networks, or with the other practices in the network.
Yeah, effectively, it's a joint venture contract. Effectively, that's effectively what it is. Yeah, but as no legal entity as such. Although there might be an argument, it's an organisation for employment law purposes. I think, Guy, is that right?
and VAT as well, Kenton.
Yeah, absolutely.
Yeah, I'm not sure we've got time for VAT, but I mean, if you're in one line, there are issues. So I think
unresolved.
Yeah, fine. I mean, just if you can sum it up in a sentence or two, why are there these sort of VAT issues? Is it just around the fact that you've got sort of recharges floating about? Or?
Recharges of staff costs is a big issue. Fine. You know, if you've got one practice employing staff and recharging other practices for use of their staff, it is causing an issue for VAT and from a legal perspective as well, from employment law perspective, which a good medical specialist lawyer will be able to advise on as well.
Probably got time for one more question. I think this will sort of touch on a few. Hopefully, a few of you can dive in on this one, but it's still sticking with annual allowances and sort of pension issues and things like that. I think we've sort of seen it recently as well, Guy. If people take people would have heard the term 24-hour retirement. Do you want to just sort of set out just briefly what that means, what the rules around it, why they do it, and perhaps Paul can share some thoughts on that as well?
Yeah, exactly. I think typically Paul will deal with this a little bit more than us. Key thing from our point of view, and more so a legal point of view, is to make sure if you're a GPN partnership and you're trying to take 24-hour retirement, that you've got to check the partnership deed. You've got to have a look in there, see all the provisions that are in there, and make sure everything is going to be okay from that point of view. The actual 24-hour retirement it's a method to enable people close to retirement to take their pension and continue working in the NHS afterwards, albeit there are some rules you have to abide by, and I'm sure Paul can elaborate a little bit more.
There are certainly a few rules, but with COVID, one of the biggest rules, the 16 hours a week as a maximum for the first calendar month upon return, has been suspended. So actually the process would be, as Guy points out, you would ensure that if you're a partner, you have written confirmation from your partnership that you can retire and return, and make sure that that includes how you are to return. So be it salary, GP, back as a partner. If it's to be 8 sessions, maybe be a minority, but if it's 8 sessions, if it's 6, 4, whatever it may be, then likewise, as things stand, you would liaise with the CCG to get written confirmation from them that they can vary the contract. Once you have those two acceptances, it's a case of filling in whichever form is sufficient. So if you're still working and going back in, and within the NHS, it'll be the AW8. And if you're working elsewhere, but not the NHS, potentially it's a different form, an AW8P. That is submitted, I'm afraid, typically via PCSE, which may take a few more weeks than you hope to process. So certainly if you were to leave somewhere in the region of 4 or 5 months to process that from start to finish, certainly 6 should work. It's important at that point that you've liaised with these guys and ladies within the office to ensure that you have got all of your annual allowance position sorted and organised in advance of retiring. But without question, it's probably for GPs one of the greatest creations there can be, because you as a practice will agree to your retirement and return. You determine the contract that you return on, or the basis that you return, whereas for consultants listening in, it's at the mercy of the trust. And the trust may well give you a rolling contract that may not roll for particularly many years. However, make sure you have written confirmation from every party you are dealing with at that point to ensure that it's what you want to achieve. But certainly the receipt of the pension and then additional drawings for working seems to leave many GPs and consultants that have taken 24-hour retirement able to ease back their workload but keep their income loosely the same, and then just ease into full retirement in several years' time, depending upon when they want to actually stop working in the medical sector.
Do you think we'll see it less with the sort of pension reforms and changes to annual allowances and things like that? Do you think you'll see it less, or is that not necessarily the main motivator?
At the moment, if anything, we're seeing it more. I think COVID has definitely focused the mind for a lot of us. And by that, I mean us within the panel, but also everyone listening in. It's allowed us to view the fact we can work from home. We don't necessarily need to commute around the country to speak. We can do it in front of a screen. But it's also allowed others to review how they were earning their money and how they were spending it. I guess should a version of lockdown or similar continue and us not be able to travel quite as far afield as we once could, that may curtail expenditure on holidays and trips abroad. There are many aspects of life that have just changed. And what we're seeing is the front line was absolutely staggering in the way it's dealt with COVID. But now are having some time to review their options and what they're doing. So someone in their 50s now may be looking to access their pension but work less. They understand an actuarial reduction will apply. But in taking that reduction, so a reduced pension forevermore, they access potentially a lump sum that could be used to clear liabilities, to assist the children onto the housing ladder, or whatever purpose. They receive an ongoing income for life. And if they return to work, they receive income from working as well. So at the moment, there's definitely increased interest in 24-hour retirement, which is saying something because it was already quite popular. Yeah. It may well ease into 2021 onwards, depending upon how things change. But certainly at the moment, it's something that many are reviewing. And I'd say it's absolutely essential that they have the agreements drawn up. So partnership agreements by medical specialist lawyers, and just make sure they tell people. If that's the plan, make sure you've told the accountants that you're planning on taking 24-hour retirement. Make sure that your annual allowance position has been quantified, qualified, and then dealt with. Because what you do not want to do as a retiree is find out after you've retired, there's a tax charge, not for income that you've received, but for pension growth that you may well benefit from for the rest of your lives. But that's going to use a chunk of your lump sum as a consequence because it's a tax charge. Yeah, so just trying to line things up in order works very well, and certainly as an option, it's fantastic.
And specific on that point, especially linking that with the consultation that's in place as well, it'll be interesting to see, because any deciding to retire, you're going to have to make that option. And then again, in comes the potential additional annual allowance charges as well.
Thank you very much. So with all that sort of a bit more spare time on people's hands, now's a good time to be speaking to their IFAs and accountants and just taking stock. So thank you very much for that, you two. And thank you to the rest of the panel. Unfortunately, that is all we've got time for in this session. I'd like to thank all those for attending live and for those that submitted questions in advance and during the session by the chat. I would also like to thank the panel at Burgess Hodgson, and in particular our special guest, Paul Gordon, for joining us. We hope this has been useful, and we will be in contact with all the attendees to follow up. And of course, if you have any further questions or feedback, please do get in touch with us by email via info@burgesshodgson.co.uk. And we look forward to hearing from you. From Gemma, Guy, Kenton, Paul, and myself, we hope you have a good evening. From all of us at Burgess Hodgson, we thank you and the rest of the NHS for your services during this difficult time. Thank you very much. Thank you.